All right. Good morning, everybody. TGIF. So we got non-farm payrolls this morning, but does the market even care? Powell made it pretty clear they're not going to cut in March. So the January numbers are more of a hypothetical, maybe a discussion of scholarly interest rather than, oh gosh, it's going to affect anything that the Fed is going to do. So of course, we still want to pay attention to it. Non-farm payrolls has a history of generating big movement in the candles. I just don't see, unless they're off, right? If the numbers are out of whack, I don't see how it's going to change the rest of this week. NASDAQ's leading the way with positive earnings from tech names, Amazon and Meta specifically. Meta offering a dividend now. And Hong Kong down the most, which really isn't all that much, but it just points to more of that lack of follow through from the stimmy. So 8:30 and then 10 o'clock for the biggest events today. And really that's it. This that rig count is not going to be an issue. The number doesn't change that much. Looks like they might have added 20 rigs last year in total, maybe. So the afternoon 0 days should be good to go without any interference. Not even seeing, speakers. I do expect some over the weekend, though. I would expect some of those Fed members to get out there and start chipping teeth. See, they mentioned a little bit about looking for, a cooling in the labor market, which could lead to policy easing. It would have to be some just drastically negative numbers. That's all right, though. I think we've had enough events for the week, right? Let's just have a good, decent day of price action without chasing all the events all over the place. Yeah, right? Good morning, good morning. Any day I wake up is a good day. We're looking pretty good on the week. If you think about how the market is looking, we're at the top of the candle. We recovered from last week's low to the top of last week, broke out on a really nice expansion. I mean, this, you couldn't ask for anything better, right? But can we keep it through the day? And, we're a little extended at this point, but in a minor amount. How far from this 10-week we are really comes into focus. So this is a lot of stuff. I know we got things going on all over the place, but just one piece at a time. What was the cumulative overnight volume? That was sitting at around 79. Now that's kind of light. We've been seeing numbers in the pre-market just this week in the 90s, another 90, right? So there's some lighter ones earlier, 60s, but this is light. And this tells us that they're standing on the sidelines looking for information before they get in. We also can see that they're hedging. Now, if we didn't know today was non-farm payrolls and we just came in and seen the volume was really light, we would be concerned. And we'd want to know why. Go hit the news and dig around and try to find, why is the volume so light? And usually it has a simple answer. Maybe Europe was closed for a holiday, or one of the Asian markets were closed for a holiday. And that usually accounts for the volume discrepancy if you can't find some kind of economic event, right? But if you do find the volume really low, you want to know why. Today's not a big deal. We know why. It's non-farm payrolls. They're waiting on it. And the market reflects that with this really nice tight range. But we also see that they're hedging. So they're not just waiting, they're worried. Hedging is cost, just like when you buy car insurance or house insurance. It's cost. There's no monetary benefit like a trade. There's just covering your butt, and it costs you money. So we know if they're going in and hedging that they're worried. They wouldn't just throw money away for nothing. And they are hedging. We know that they're hedging because the market maker move is a design that Thinkorswim thought up years ago. They created it out of their imagination. The market maker move. It's looking at the front options, which is the closest expiring options. And it's looking at the next series out, which is the back options. If the implied volatility average is greater in the front than it is in the back, then we have a market maker move. Generally, you see that when things are about to report earnings, investor day events, a new drug trial, when there's some unknown that is about to hit. But when you bring it over to the futures, we don't have drug trials and earnings and dividends and investor day events. We just have econ. And when econ has them worried enough, we begin to see hedging. This implied volatility average that I'm pointing to is derived in part by options trades that are going on out of the money on both the put side and out of the money on the call side. Now that's some of the math that goes into this number. It's a proprietary process. They don't share with us all of their secrets. We know it includes the square root of time, and it includes all of the implied volatility average from all of these options. So each strike has its own implied volatility value. When trades go on in here, it increases or decreases the cost of these options, which changes the implied volatility, and how fast these change in value increase or decrease the implied volatility, that changes the average. So if they come in hedging, trading a bunch of out of the money options, loading up on insurance, it will change the implied volatility average and make it get higher than the next series out. And thus we know they are hedging. So it's not my opinion. I don't think that they're hedging. I know that they're hedging. That's how we know. It is short duration. They're only hedging for the morning. As soon as this event is passed, they don't need their hedge anymore. We have an MDP this morning. That's a missed daily pivot. And again, I know there's a lot of stuff on my screen. That's why we just go through them, take them apart one at a time. So there's the daily pivot. 49.32, basically the cog line. We're kind of a little higher than that. So that's a little bit of a concern. We start getting into, you know, our levels at that point. If you've ever dug into just your basic regular floor pivot model, then you've seen R1, S1. We can use something like Person's pivots, which are already preset. Should have the R values. There we go. Now, Person's pivot is supposed to be, quote, a smart pivot. It will analyze the market and decide if you should be long or short. In today's market, it thinks we should be long. So it gives us an S1 and an R2, or maybe an R3, either one. If you wanted one that was just going to give you the pivots, you could try something like SVE. This is more of your basic floor pivot model. It's going to have both sides equally. So you can see we're at one of the restriction pivots already. It's not really a big deal because it was basically the 4 to 5 price point anyways. But still, it's nice knowing where the pivots are. So right now we've got this liquidity draw that we have to get through. It's going to be very hard to get through that, as we're going to see when we get through the other volume pieces in a few minutes. But this daily pivot point, we're kind of extended. You've seen from the levels that the next level up is a long ways off, right? I'm leaving it on that other screen because it's just more pivot points. 49.91 and 507. It's a long ways off. So we really don't have to worry about the next R level. But we are extended a bit. And the more important one, or the one to be a little more worried about, is the weekly pivot point. We're a bit extended from that. We have the ADR level, 49.76. That's also at the call wall. Spot Gamma changed their indicator bubbles, so they're not so big and loud. So that's the call wall right there, 49.75. It's going to be really hard to get through the call wall after we get the economic data today. Non-farm payrolls can spike us up through that wall, but whether we can keep it or not is a completely different discussion. There's the potential today for a liquidity gap, and that is going to be a pretty big deal as well. So I've kind of gone through this before. What a liquidity gap is. We get the opportunity for this 3 times a month in the pre-market. Non-farm payrolls, PPI, and CPI. So this is what we want to see. A single directional push, consolidate, and then we work our way back towards where we opened. Now, I know you don't see a gap. You see a candle. It's a liquidity gap. So at 8:30, if we get a big move, and I don't care which direction it goes, it doesn't have to go down, up or down, we get a big move and then it consolidates, we'll look to try to close that gap. It got back to the gap close around 11 o'clock in this example. Here's a different one that went to the upside. Same thing, big gap and up. Not much of a consolidation. It just started working its way back down. We got there around 11 o'clock. I mention watch the clock all the time. Shouldn't be surprised that it gets there at 11. Another example. It kind of feels like the same one though. I think that was a different one. Here's CPI though. multiple candles in the same direction instead of just one big push, but it was a single directional push. It got across the top, started to base, consolidate there, worked its way back, got there around 11 o'clock. This is what we don't want to see. I always try to find examples of what we don't want, because I think strategies, like anything else, can be confusing to people who don't know them very well. And so showing you just what works without what doesn't help anybody. So this is what we don't want. Big swings on each side with big wicks on each side and closing near where we opened that candle. That's not what we want. You see that, and it's just forget about it. There is no trade today for the gap close. We'll trade something else, right? Trade these rejections off the highs or something. So it needs to be a single directional push. This is another picture, same idea. Another one, same idea. We don't want these, right? We want something else. Another example of what we don't want. So this is what we do, right? And the easiest way to do it is at 8:30 when you get the big print, just take your marker, draw a line at the open of that candle. And do I know we're going to get one of these today? No. With the data, with the market's attitude over this comment Powell made about March, the market might not care all that much. Plus, they seem to have it dialed in pretty good. And I got to say, when they're that confident, that's when I'm ready for some fun. Some of the biggest moves we get in the market is when they think they know what the heck they're doing and they get all cocky about it and they say, well, we know what the job numbers are. Oh, you do? Oh, okay. They say they do, and then they'll come out and it'll be wrong and they're off sides and they got to scramble and all the fun stuff happens. So if they're caught off sides today, we'll get a really big move. Otherwise, I don't expect it to be as big as our normal CPI move. Let's say it that way. So the ADR today is wide. It's almost 1%. When we add the market maker move to it, which is another 0.5%, we want to add it from the yellow line. So let's say the market gets bullish today. 5,000 is the full ADR. We would then add another 25, call it 26, another 26 points on top of that from 5,001 plus another 26. That's 5,027 today. Easily. We could easily do that. Now you might be looking at this saying, but we had this really big move yesterday. It's probably tired now. That's exactly when we can do it. If you remember not last Friday, the Friday before, this really big blowout Friday, that came after a big recovery Thursday when we went from the lows of the day and we rallied all the way up into the highs of the day on that Thursday and then broke out on the day into new high days. And everybody was looking at Friday in the same scenario. Well, we had a big move Thursday, really not expecting much today. And oh boy, we got it. So don't look at today as, well, it's probably over. We've already had such a big move because we can get more. It doesn't owe us more. Let's be fair about that. It doesn't owe us anything more than what we already have. We have a really good week. Nice breakout. Everything is looking, reasonably well. If it holds this, the market would be happy with it. But if we start to break out, and especially if we can get through this call wall, it's at 49.75 basically. It's halfway to that 5,000 mark. If you go from 49.50 to 5,000, that's your midpoint. I don't know. I think we can do it. One of the things you're going to want to see is broad participation first in the FANGs, the Mag 7. That's not much of a surprise. But you want to you're going to want to see that move from finance yesterday start to turn around a little bit. We can't have that much negative finance and still carry our rally unless the Mag 7 are going to do all the work by themselves. And I find that a little hard to believe. So we're going to need some finance in there. And KWEB took just a beat down yesterday. KWEB and insurance and finance, XLF, it was good. So we're going to need some help there. Broad market participation. We want to see a high number of advancing versus the declining issues. And we want to see good, solid green ticks with the ADR half riding up into 250 really early in the day. All of those, and then get that solid push, which kind of says if we get a CPI print that puts us high really fast, that we might not get that gap close. We might get that really big candle and get some consolidation into the open, and then get into RTH, break out, and keep right on going to the upside. So a little bit of caution if we do get that big candle, that it might not be a gap close. It took a while, but here's an example of that. The QRA, big pop up, took some time to digest. What did it do? It came back and closed the gap. Those big gaps can happen, those big candles can happen anywhere. So you can get a gap close play like that even in the middle of the day. We're going to lose the rest of this volume today along these lows. So by Monday, unless we break out, we're going to have about a 110 point range, which is what we have right here between Thursday and Friday. That's our range, because all of this will be gone. In which case, we're almost going to have like a classic D shape. It's sloppy, but I guess it's there, like a D. It could turn into a B eventually, but for the moment, what I'm really focused on is losing this volume down here. We lose all of this through the day today, and when we come back, it'll just be this really tight range. So if we break out today above this level, we're going to end up with more of a classic B, because we'll get this kind of stuff on the upside, right? See if we can do it. It should work. Yeah, there you go. It would look something like that, right? Which would give us more of that classic B shape. I know it's weird. Don't flip the market over. All right, the first touch was way too late to do anything about. So it was there, it got hit, but that doesn't do us any good. And we're done with it anyway, so we'll just take it off. I'm actually going to just carry it down because we have a VPOC now down here. And this one was hit. We're done with that. 48.92 cog line and point of control. If we get down there, that's a first touch play. One, because it's the cog line, but two, because it's the VPOC. I think we need to add a tick to this. Yeah, there we go. Good enough. Yeah. So it really highlights our range this morning. We're getting a little bit of discrepancy. We came up and hit a ceiling here. We didn't spend very much time, but we've already collected a lot of volume. Very likely we popped above that level and came up right into some volume that was on the dome, right? So we got into some liquidity that triggered that great amount of volume. So we've been hovering at this level for a little bit. That's what this shows. We've been there for a little while, but we've got a lot more volume. So we triggered into a ceiling. Is it done yet though? That's really what it keeps coming back to. And notice where this cone is. It's right against this. If we consider this rally base drop spot right here as unfinished business, every time we get back in there, people are going to want to get their business finished. It really is just that simple. They're going to want to trade there. You wouldn't want to approach it just so simple as that, right? 49.75. You wouldn't even necessarily want to wait till it got there to go long, right? Instead, it'd be level by level. So if this is the liquidity that we were just talking about, and the market's having a hard time digesting and getting through there, once it does get through there, remember I often say liquidity resides on the other side of the pivot. Right now, the liquidity is actually in the pivot because this is a rally base drop zone. So if we get through that, there's not supposed to be any liquidity now on the other side because it was in it. So we'll expect to see a little bit of a Busby. Remember, old resistance becomes new support. So once we break out of yesterday's range, then it should just be a breakout day. The question at this point, though, are we supposed to buy the breakouts today or not? Remember, on Monday, Tuesday, and into Wednesday morning, we were selling breakouts and we were buying breakdowns. Sell into weakness, buy into strength is the other side of what we were doing. So should we buy breakouts now? We weren't buying on Monday, Tuesday, and Wednesday morning because we were waiting on FOMC. We knew the market was range bound. We knew we needed this data. And so we were selling rips, not buying dips. For this breakout, we need that data. We need non-farm payrolls. We're going to get a really big candle at 8:30. And that really big candle can be a really big candle with those wicks on each side. I showed the pictures, or it can just be a really big candle in one direction or another. If it's an upside breakout and gets us up there, we'll be opening on the day around that red line, 49.75. But this red line is called ADR, average daily range. It's the thing the market does the most, right? What does the market do on a day-to-day basis? The same thing that it does yesterday, and then the same thing it did before, and the same thing it did before. So what's it expected to do today? The same thing that it did any other day. If we hold to that, it's going to get to that red line, and it's only going to get to that red line. It won't get past that. It won't go to the yellow line. And if it does go to the yellow line, then that's going to be the end of it. Very often, that's it, right? Now, on Thinkorswim, I can't show you previous days of ADR. It doesn't have a yesterday's showing, but on TradingView, it does. So if you happen to have TradingView, you can go back and bring up something like the ES with the ADR levels. And you can just go back and look. How did it do yesterday? How did it do the day before? When it gets to the yellow line or to the red line and breaks through there, does it go to the yellow? All right. To me, getting to the red line is usually where we're done. Here's a great example. We got to the red line and we kind of chopped about there, but this was POW. This was FOMC. So that whole expansion beyond red line came because of POW. Generally, though, that's the end of it. We get to the red line, we get shut down. Get to the red line, and we get shut down. Now, if we get to the red line early enough in the day, we can revisit it and we can get through there. We get there early in the day, we can revisit it and we can get through it. So it's not as simple as just, well, let's get to the red line and then we'll go long from there. The red line very often is the end of the move. And if we get to the red line early enough in the day, we can go to the other red line because we have room, we have time. Average daily range. It's what the market is supposed to do on a day-to-day basis. What does it do on average? It goes to that red line. So we're going to get non-farm payrolls. That's very likely going to push us right up into that red line and probably above it a little bit. Or if they are negative, then it's going to push us down. I don't know if we'll get all the way to this red line in one shot, but it'll push us down towards the daily pivot point and the previous week's high. We'll probably hit that and then start to consolidate. And we'll have to take it from there. Yep. A good rule of thumb is to play the breakout after you've already established that you should buy breakouts. Remember, Monday and Tuesday and Wednesday morning, we were not buying breakouts. If you have a breakout plan for trading the 5-minute open range breakout or the breakout of yesterday's high or the breakout of the Globex, they're all the same trade. They really are. They're all the same trade. So you can lay out like your 111 warning center, the 1, 2, 3, 6, and expand the breakout from there and go for halfbacks and breakdowns and just keep measuring your move on through. Right now, the focus is CPI. Is it going to turn the entire market negative? Is it going to turn the entire market positive? And at that point, are we going to continue to expand through the day and have one of those Fridays where we just run into the close, up or down? Or are we going to stay range bound going into the close at the end of the week because nobody wants to get long before a weekend? That's the biggest thing on our block right now. China ADRs are down through the K-Web, so we're going to expect the same from BABA, Baidu, JD, PDD, probably the EVs as well, NEO, XPEV. And really, beyond that, nothing else. Remember, the benchmark is 0.5%. So if something isn't up or down at least 0.5%, we don't even focus on it. And the China ADRs through the K-Web is the only thing we have that's down 0.5% until we get over to TrendSpider and we look at like pot stocks and something like that. On this side, we've got communications up the most with XLC and then the MAG 7 behind that. Even the SPY growth ETN or ETF is up this morning. Those things don't normally even get flows. The XLC as a product does not normally get strong pre-market flows. A lot of times it's just yesterday's after hours flows, and then we're looking at it this morning. So be careful with XLC. I'm seeing a little bit here, but it looked like most of it was just last night. Yeah, a little bit of flows, a little bit. And this is very unusual. It shows how much they're in here trading it. Because you would normally not see XLC getting any kind of real flow this morning, and certainly not the growth ETF or value, right? Because there's a value one too. Neither one of these ETFs normally get any sort of activity in the pre-market. Not enough to register anyways. And they are today. This leads me more to believe on that breakout. It really does. It's just one more piece of the puzzle that says after we're done with non-farm payrolls, whatever we get from that this market could run today. And I mean run today. It'll be one of those continued days where we keep saying, I can't believe how far it's gone. Surely it's going to turn around, and then it just keeps going and it just keeps going. We're primed for one of those. We got semiconductors, communications, the odd like cloud computing. That thing doesn't get flows early in the morning. It rarely ever gets flows until 9:30. We're even getting a little reflex in gold, uranium. It's odd to see emerging markets up here without the China ADRs through the K-Web. This is the IWF IWD, growth versus value, and you can see how bullish it is. We closed down here underneath the 10, but above the 20 after this rollover. And this morning, we're all the way up here. So we closed here and we opened, or at least right now, we're way up here. We're very close to a breakout, a continuation. And, put it on a monthly. This is like getting into uncharted territory. Very bullish on the market, not just for today either, right? Like continued swing trade long kind of stuff. This is the Mag 7 with weights. It's very close to like the NY Fang. Notice it has the same setup. We closed down here after failing to get through the 10. And this morning we're opening way up here. And we'll just put that one on a monthly too and zoom out. Unheard of, unprecedented levels. Very bullish. Even with this pullback, it's still very bullish. And now with this gap up, today could be a ripper. So if we are going to get a ripper, or at least just get a reasonably decent day here, so we got Tesla, gap down. We're range bound in this morning. We got a long ways to go for this just to even get to one edge or the other to give us a play. If I was looking at this on a Friday, I would try to find something else. I don't want to trade inside that range. So we'll just let that one go. Google. Google's closer to its own high of yesterday. And yesterday was a really tight range. I like that. Plus, we have this set up here, right? The 2-bar. That's what, the Haramni? So, set that aside. We do have that really big gap. We could be looking for a little bit of reciprocation, right? Like a mean reversion, least squared methods kind of thing. This is a massive gap. And, at some point it may eventually fill that, but it's not going to be today. But with this really tight range from yesterday, if we can get above that, we can easily just double the range. We're not asking for too much, right? So if we get an inside day breakout, get above that 100%, we can focus on the open and then getting above that high, and then we'd get 100% of the move up here. Notice we're holding that 50% of yesterday. It doesn't have to hold here in the pre-market, but when we get CPI, we want to see that good news pop Google up enough to get through that 143 so that we open in the RTH above that level. We want to see it open up here and then fade back maybe and get a little Busby bounce and work its way up. If we open above 143, then we could aim for 144, 145. I wouldn't expect, getting back up here, but yeah, 145, that's not bad. It's $2. Microsoft's already getting the breakout. It's not waiting on data. So another one, if it can keep the breakout, we want this big earnings candle. It's above the 50% mark. We want yesterday's candle. And obviously it's above that too, because we're getting our inside day breakout right now. It needs to hold above yesterday's high, that 408. Now we can wick down there. We can, even with CPI, we could violently fall down into there and say, come into that 405 area. I wouldn't like it, but we could do that. We still would need to turn back around though and get that rally up into that 411. If it's going to get a really wild day, then we could get up into that 415. But I mean, we're really reaching that. I won't be, no, I won't be live for CPI. That's a fair question. The question was, how come I'm not looking at anything on the downside? I mean, true, even Microsoft could be a trade to the downside, but think about what it would have to do first. It'd have to run all the way through yesterday's range and then break out of that. Because I wouldn't try to short it here for a day trade, knowing that all these pivots are in my way to stop me from having a good short. Now, if I had a reason to short it other than just, like PPI or some tangent connection to it to make it a short, that'd be different. But if it's got bullish flows and it's at the breakout of yesterday's high, then I'm not going to try to short it from there without a reason. NVIDIA gave a great interview where they're trying to hype up other nations to use AI, right? Which of course promotes their product more. Yeah, I think they're going to have another really great earnings when it comes back around again. But this morning, inside day breakout, continuation after this consolidation. And my track record for earnings is atrocious. So I'm bad at earnings. The only time I do good is when I trade them the way I like to trade them, which is before and after, not picking directions for which direction it's going to go when it reports. So there's our breakout out of this zone and outside of yesterday's high, 632. But we've still got 634, call it 635. And with that, we're already above it. We're at 643. That's all the way up here. There's NVIDIA this morning, 642.70. People really liked that interview, right? So we had this nice tight consolidation and then this big breakout. If you're lucky, the market is going to sell into that today. Not like a big crash and burn kind of thing. Let's just come down here. It had a big gap up, right? And it ran up a little bit more and then it fell like a dog and it rallied back up. It closed higher than the previous day, but it closed lower than where it opened, right? So, and it continued to be bullish, from there on. So if you're really lucky, this is going to give you a chance. See those wicks at the bottom? In this breakout today, up into this 140 something. Maybe it falls back down, gets the gap closed, and runs back up again. It gives you a chance to take it for a ride. Nope. There's nothing more we can do with it. We just got to wait for CPI. So let's finish up the way we normally do a Friday. Take a look at next week's range and compare it with this week's range. And notice, by the way, we're still inside the week. This is the range that we were expected to stay in for the week, and we're still inside it. We'll close inside of this range 80% of the time. When we don't, it's usually because things are getting violent enough that it's breaking the range consistently. Breaking it once in a while, of course, happens. That's why it's 80%, not 100%. But if you get repeated closing on Friday outside this range, 1 week and then another week and then another week, oh man, that's a big warning. This warning is something's wrong. The market makers are getting it wrong. The volatility is not being read. Something's off. So we've had a lot of weeks now in 2 weeks, 3 weeks now in a row. Today's not done, so can't really count it yet. This week we closed out outside. This week we closed outside. We closed inside last week, and it's looking like we might close inside this week. So after 2 failures, we might get 2 that hold. That's 50-50 right there. I don't like it. I want an 80, not 50. Easiest way to count for percentages, just go back 10. If you find 3 out of 10, then you're at 70%. 2 out of 10, you're at 80%. Next week's volatility, it seems a little greater than this week. Ponder on that for a second. This week was QRA and non-farm payrolls and FOMC. And next week has more volatility than this week? Okay. That makes me a little nervous. What we got on the table for next week? I think there's some stuff coming out of Japan, but that's it, really. For that rally that I was talking about today, we want the dollar to break our own Globex low. Let's do that since we already are below Wednesday. Well, we were below it. Let's get back down below Wednesday, down below our own low, get to that 102.5. And for the 10-year, let's get back below Thursday. That's asking too much, really. Let's just hold the range and not see a breakout up above Thursday's high. If we can do that, get that dollar drop, we get the yields just holding steady. They don't even have to fall. Then we could add to the bias that we might get this breakout that really sticks and we get one of those rip your face off rally days. We're going to want to see US dollar Japan hold the line. Let's just not get above, say, our own high of today. If we do break through that, I find it hard to believe we're going to get this carry through to the upside, but we have the 10-day moving average up here. Let's keep it under that. And really, we don't even want to get there. We don't even want that much bullishness. We've been holding really nice underneath this 10 on the way down this week, and we want to continue to do that. So dollar weakness, yield weakness, let's carry both of those into today on the other side of non-farm payrolls. And if we do, we could get that breakout in the S&P and the NASDAQ. Now, I've been talking bullish on the S&P all morning, but it doesn't owe us a bullish move. We could just go sideways and do nothing else. We're at 3.6% away from the 10-week. You can see that we've been higher than that before, so we're not too overbought, but we're getting there. We're getting a little stretched from the 10-week. Bring it over to a daily perspective, we're only 1% away from the 10-day moving average. We've been much further than that before. So in the shortest duration, we're not overbought. We haven't moved too far, too fast, and it doesn't owe us a pullback. But if we break this Globex low with CPI pushing us to the downside, then I think we can cut through this ADR half relatively easy, and we'll focus on this blowout point, which is that liquidity gap that we now have. That'd be closing the gap. And then the full ADR. Now that's the NASDAQ. Put it back on the ES. It'd be the same thing, right? If PPI comes in, actually, if non-farm payrolls comes in negative to us, sends us to the downside, we get through that ADR half, which will be closing the liquidity gap anyways. We'll target the ADR full. Then we'll target the Globex high of yesterday, the RTH open of yesterday, the RTH low of yesterday, and then Wednesday's low. Level by level by level, right on down. Everybody, be careful. Have a good weekend. I will